Well, hello, everybody, and welcome back to the next event in the Originator Connect online engagement webcast series. And it's my privilege and honor as Director of Online Engagement here at the Originator Connect Network to share this great program with all of you where we're really going to go deep on how to pivot your business to products and services that will be able to weather any market. You know, most of the financial experts and pundits that I read commentary on, a great majority are predicting that there is a potential for another reset in the real estate markets and a potential recession coming in the not too distant future. And when you think about what happens in those types of markets, you have to have product diversity that gives you the option to do business that will be strong when traditional, even residential purchase business slows down because of a combination of economic factors. So today's program, we've got a group of experts from an amazing supporter and company called CoreVest that are going to be sharing with you tips and tools on how to grow your business with investment property lending and loans. By the way, I want to also share with you that today's event is intended to be a highly interactive and engaging conversation with our panelists and experts. We want to hear from you. We want to see what more and learn about who you are and what you want to know that's going to help you grow and improve your business in what you do. By the way, it's not only with you that are already on this, but who else you might know that might be interested in taking advantage of this type of information or learning. You know, the colleague across the office or across the country that you think would really benefit from hearing this type of information. Below you, there's a widget that looks like a paper airplane. And by the way, we are going to create an incentive here for you guys to get involved and share this with your friends and colleagues across the country. We're going to take just a few minutes here. And if you hit that widget and invite a colleague, the information has already been typed in. All you got to do is drop in their email addresses and hit send. Those of you who have participated in this opportunity to invite your friends and colleagues to join us in today's event are going to be registering. Each person you share this with is another entry in a raffle drawing. Towards the end of the event, we're going to be giving away a $25 Amazon gift card. So without further ado, let's get into the meat of the program. This program is totally about you and how to help you grow your business with a unique set of product that a lot of originators don't typically understand. And so today we've got two great experts from CoreVest. We've got Mr. Chris Heffel, who is a seasoned veteran in the industry, somebody who's been doing mortgage business for well over 35 years with a wide variety of experience. Chris, why don't you say hey to the folks for just a few seconds?
Thank you, Eric. Yeah, we're pleased to be here with everyone and excited to talk to you about not only our company, but some of the products we're offering in the investor space.
Awesome. I also have somebody that I've grown very close to over the last couple of years, getting to know him in a variety of different environments, even at his previous company and now working with CoreVest, is Mr. Sam Bajalik. Somebody I have a tremendous amount of respect for. He's a great speaker and educator, and I think he's got a lot of awesome information to share with all of you today. So at this point, I'm going to step aside and let these guys take and run the ball here. So Sam, Chris, I know you've got a ton of information to share, so let's get to it.
Sure. I'll go ahead and start, and we'll talk a little bit about today's agenda. We can set the table for what we're going to take a look at. Today, the agenda slide, please. So the beginning, we're going to talk a little bit about our company, right? I think it's always important to know who you're working with, who you're listening to, who's giving you advice. Then we'll talk about the opportunity in the single-family rental space. We'll talk about what the market's like. We talk about where the opportunity is, what we're seeing. Again, this is all what we do, and you'll kind of see that as we go along in the presentation. This is what we live and breathe. We're not doing single-family Fannie and Freddie loans. We're not doing FHA and VA. All we do is work in this rental space. So we'll hear about the market opportunity, what's out there. We'll talk about some of the programs. So how can you take that opportunity? What kind of programs are out there you can put your clients into and originate loans? Then we'll also talk about how to partner with us. That's kind of why we're here today. We'll talk a little bit about how brokers today are doing business with us. And then we'll talk about some next steps, a couple action items, and ways you can take what you learned today and produce some business out of it. So right here at this point, I think I'd like to hand it back to Chris. I think he has a video to share with us that'll talk a little bit about the beginning of today.
Okay. All right, well, thank you, Sammy. So I'd like to talk a little bit about CoreVest, what we do, and what the residential investment property market is. So CoreVest is a specialty finance company. We were started in 2014, and we're focused exclusively on residential investment property. What do I mean by that? We're looking at single-family rental properties, townhouses, condominiums, and to a lesser extent, multifamily properties. The key is that we're looking at assets that are income producing. These are not consumer loans, and we're underwriting and sizing our loans based on the income that comes off the asset, not necessarily on the borrower or the borrower's income. We originate loans through multiple channels. That includes brokers, correspondents, wholesalers. We're very focused on the loan origination platform. I've been on the MBA board for many years, and we'd like to develop relationships with many of you to source product to us. And as you can see in the graph here, since our founding in 2014, we've had fairly steady growth. We've already originated over $3.5 billion in loans in the residential investment property space. Now, a little bit about our history and how we got here. We were founded, as I said, in 2014. What happened post the housing crisis is that a lot of big institutional investors started buying up homes and converting them into rental properties. They had the access to Wall Street capital, to big banks and lending institutions. And while they were buying these assets, we noticed that a lot of the smaller mid-sized investors didn't have access to that same capital. So we saw an opportunity to create a lending platform that catered to these small to mid-sized investors in residential investment properties. And that's how we got started. We're actually making a bridge from Wall Street to Main Street, in a sense. We're letting smaller investors access Wall Street capital. And by that, we can offer really attractive financing to people who are buying investment properties. Since we started, we've closed over $3.5 billion in loans. We've financed over 25,000 investment properties, and it's really just scratching the surface. We'll talk a little bit about the market in a bit, but we have become the leading investor to residential real estate investors in the country, and we've done that directly and also through financial intermediaries such as yourselves. We are located in several offices across the country. We're based in Irvine, California, in Orange County, with an office in New York. That's where I am, and also an office in Los Angeles. But we have people located throughout the country, both originators and underwriters, and they're located in Texas, Arizona, Nevada, Florida, and Maryland. And as you can see from this map, we have a nationwide footprint. We have already financed assets in 44 states. And I think a really interesting thing for you is that you are able to originate loans, not in the state you're located in, but you can originate loans all across the country. So this gives you an opportunity to expand your client base, as well as to expand the number of products that you're offering. A couple highlights about CoreVest, a few of these I've mentioned before. Again, $3.5 billion of loans closed, 25,000 properties in 44 states. We're one of the first people to do GSE lending in the SFR space. We completed a transaction with Freddie Mac at the end of last year, and we are an approved seller servicer for Freddie Mac under their Flow program for SFRs. We're one of the very few correspondents for them. So not only can you access Wall Street capital through our programs directly, we also give you access to Fannie Mae or Freddie Mac programs, and possibly Fannie Mae in the future as well. We have multiple delivery channels. So as I said, we work through correspondents, through wholesalers, or just simply through brokers. We have a number of different programs that Sammy will talk about later that allow you to source product to us either directly or indirectly. And one of the interesting things about our business and our program is that we offer products for the full life cycle of an investment in residential investment properties. So we provide acquisition financing or lines of credit to allow people to buy assets for either aggregation or fix and flip. We provide renovation funds for those fix and flip assets. And then we also provide long-term permanent capital, either for blanket loans on portfolios of assets or for one asset at a time with a single asset product. And I think Sammy has a couple questions for the audience.
Sure. Actually, before we get into these poll questions, one thing I wanted to note is, please, I encourage you to use the Q&A section of the broadcast. Any detailed questions that you have, we will put them in the queue, and we're more than happy to answer them as we get towards the end of the broadcast. So here's a quick poll, quick survey. If you could answer it, we'd really appreciate it. We'll run through these. Again, do you have any clients that purchase multiple investment properties during the year? Take some time to answer that one. And I think we have another one coming up. Do we have another poll question? Oh, here we go. Hey, how about that? This one, pretty important. Have you ever turned down loans on rental properties because your client's tax returns would not support the traditional Fannie Mae or Freddie Mac DTI guidelines? Perhaps they have a more complicated tax return. They own multiple investment properties. Maybe they're self-employed. They have a lot of write-offs. Just curious if you've ever turned a loan down for DTI on an investment property. Thank you for answering that. I think we have one more before we get back into it. I'll ask the marketing team. Hey, there's one. Foreign nationals, right. We're seeing this all throughout the country. You know, it's tough to get a foreign national loan done. Just curious if you ever had a foreign national looking for an investment property. I appreciate your participation. Well, I think here we'll hand it back off to Chris, and he's going to talk a little bit more about residential investment property loans and the marketplace.
Thanks, Sammy. Yeah, so maybe just to level set, I want to make sure we all are talking about the same thing, and I'd like to define what we call residential investment loans. These are basically commercial loans that are secured by residential property. In other words, they're non-owner occupied properties. So these can be loans secured by single family residences that are leased out, condominiums. We do a lot of business with individual condominiums or broken condominium projects. It could be a townhome or an attached home or multifamily assets. And you'd be surprised how many multifamily assets we see. These tend to be smaller properties that may fall below the radar screen of institutional commercial lenders or Fannie and Freddie. The real key thing to this, and one of the questions alluded to this, is we're underwriting the loan based on the income that the property generates. We're not focused as heavily on the income of our borrower or sponsor. So these are loans secured by the real estate and underwritten based on the income that is generated by the property. So we tend to focus, again, on properties that have leases in place and are generating income. Now, this market, many people think the investment market for residential real estate really came up after the financial crisis, but that's not true. It's really been a major part of the housing stock, and in particular the rental housing stock, for decades. But since the financial crisis, you've seen over $50 billion of investment capital come into the space from institutional investors. That started with equity investors who were buying up distressed homes, a lot of them as a result of the subprime crisis, and later it was lenders like ourselves who were bringing institutional debt capital into the market. So CoreVest, as I mentioned, was formed to provide financing to these smaller and medium-sized investors who need debt financing to participate in the residential investment market. A little bit about the size of the market, of 118 million homes that are in the U.S., 30% are rented. And this includes primarily apartment buildings, large apartment buildings, about 18 million units. But surprisingly, about 16 million of them are single-family rental units. So just by itself, single-family rentals is about the same size as the multifamily market. If you include townhomes and some of the other assets that we're looking at, small multifamilies, it's actually larger than the multifamily market. So it creates a huge opportunity for investors in this space, and by Transit Properties, huge opportunities for you to generate loan volume. Our target market is about 30 million units in the U.S. The residential investment loan market's been driven a lot by a number of demographic trends. I think many of you are aware of the decline in home ownership that has taken place since the financial crisis. Today, home ownership has declined from about 69% of households to 64%, and it seems to have stabilized there. But it's a pretty low home ownership rate. Conversely, it's a very high rentership rate. And I think that high rentership has been driven by a number of different factors. I like to talk about demographics, dislocation, and desire. Demographics is simply the number of household formations that are expected over the next few years, and the fact that a lot of households were not formed during the financial crisis because people just couldn't afford to do so. You had a lot of basement dwellers or people who were living in roommate situations who couldn't start their own homes, but are doing so now. So you've got a lot of demand for housing generally, and a lot of that is coming into the rental market. Number two is dislocation. Again, because of the financial crisis, a number of people were foreclosed or had bad credit and can't get into the home ownership market. I mean, if you look back, someone who was foreclosed out of a house 10 years ago, 50% of them are still in the rental market. So a lot of those people stay in the rental market after they've lost houses. You also have a lot of people or households that are saddled with student debt or other limitations to their ability to buy a house. Maybe they don't have a down payment. So dislocation is a big factor. And the third factor I think that's really leading to this is desire. I'm not a millennial, but millennials do demonstrate I'm far from being a millennial, but they do demonstrate a desire for flexibility and mobility. They rent their cars, they rent their movies, and they tend to rent houses more than own their houses. Many of them have seen their parents suffer as a result of their own home ownership, so they tend to rent more often than buy. So we see a lot of existing and pent-up demand for rental housing. And as I said, if you look at the bottom chart here, this is not a new industry. So while we see a recent increase in demand for rental housing, the demand for rental housing, and specifically for single-family rental housing, has been pretty consistent since the 70s. It's represented about a third of all rental housing. So something that you and your clients should be very focused on. One last thing I'd like to point out, and we mentioned it in the introduction, we do see a rise in interest rates. There's been a rise already this year, and many of us expect interest rates to rise further. Increases in interest rates make home ownership that much more difficult. In fact, we're estimating that for every 1% rise in interest rates, it knocks about 5 million people out of qualification for buying a home. So that's another 5 million households that will go into the renter market. And it's another 5 million people that probably won't be coming to you for a owner-occupied mortgage. But by offering additional products, you can still capture that demand by going to the landlords for the rental houses that these people are ultimately going to occupy. So that's it for my remarks. I'll be happy to answer questions later, but now I'm going to turn it back over to Sammy, who'll talk a little bit about why you should be offering residential investment loans.
Well, thank you, Chris. And again, I want to, first of all, thank everyone for taking time out. We know your time is valuable, and we're glad to have you here with us today. Again, for the Q&A, please enter those in as we go along, and we're going to address those at the end of the presentation. So again, why offer residential investment loans? I think the main thing to get out of this is it's a huge market. Has not had much attention paid to it over the last 10 years. Since the crisis, capital's been very tight. As Chris mentioned, the large institutions were the ones that had the opportunity to go out and buy these homes. And it hadn't trickled down to the residential loan originators. And that's one of the reasons companies like ourselves are out there looking to bring this product to market, looking for companies and individuals like yourselves to distribute the product. So again, it's a large marketplace you can see there. I think now it says 55, if not 60% of folks with 10 or fewer homes. It's a growing industry. You're going to see more and more non-agency lenders come into this field. On the next slide, we'll talk about a little bit about the characteristics of a client that you're looking for. These are ones that typically don't qualify for the normal conventional Fannie or Freddie investor loan financing. They might have had lower credit scores, perhaps. They could maybe not be able to prove the income that they have. Maybe they want to close it in LLCs or LPs. This is very common for professional investors. They might own too many properties, right? Once you get over 10, it's tough. Fannie and Freddie don't want those in their normal conventional product. With us, it's unlimited. So they can own 50, they can own 100, they can own 1,000 investment properties. So something to keep in consideration. I think we talked about the DTI limits earlier. That's one reason that the products that we have available are very useful. It's an easier underwrite. Again, for those who can't go full doc. Also, it's a great takeout for those that had hard money loans. There's a huge marketplace for hard money. We are one way to take those loans out. So keep that in consideration. I think here we're going to take a brief look at what some of our investors have had to say about working with CoreVest. Great. Well, let's take a quick look at the marketplace and some of the lending products that are out there in the marketplace. So the question is, who and how do we fund these loans? What's out there now? One way is family and friends, right? This has been a way it's been done all through the years, and this will continue to go on. It's not an unlimited resource by any means, but some of you have an Uncle Joe or an Aunt Nancy out there, or it could be a friend of the family that might want to lend the money. This is great. Sometimes the low cost of capital, but again, it's not unlimited. And sometimes doing business with family and friends isn't so fun. Local banks, there's a great opportunity for that, but again, it's local. It's going to be somewhat restrictive. They might want more documentation, higher down payments. They might want to prove income. Again, that's one way that things are out there. There's an online marketplace. Availability of funds is not certain every time. Not very consistent. And then, of course, as always, cash is king. If you can buy the houses for cash, that's a great way to do it. Again, not unlimited resource, at least for this guy. But the smart investors, what they want to do is really leverage the cash. They don't want to pay 100% down. They want to take that cash, leverage it, and that's what professional investors do. So that brings us down to the specialty investors, as you see there in the bottom middle of the screen. Again, these programs aren't a nice to have for us. This is all that we do. We live and breathe investment property, rental financing all day long, every day. It's not a hook for us for you to send us your FHA or VA loans. This is what we do. It's all day long. It's what we're good at. On the next slide, we'll talk about some of the products that we have here at CoreVest. Real briefly, we'll cover the three of them, the core products. The single property loan or the single asset rental loan. This is a 30-year fixed product. Rates start in the high sixes, 75% LTV, 650 FICO, again, amortized 360 years. And very important, this is for a stabilized rental. So as mentioned before, we qualify on the lease. So we qualify on the cash flow of the property, not the income of the client. So keep that in mind. And again, it's unlimited assets owned. Our portfolio rental product, and you might know this more as a blanket loan. So what this is we take a portfolio of loans. It's minimum 5 units, $500,000. And what we can do is cross-collateralize them into one loan. They could have 10 properties. They could have 100 properties. They could have 500 properties. We've done all those types of loans. These are underwritten like a commercial loan. So we do utilize a debt service coverage ratio. It's a 5 and 10-year fixed rate. That's a 30-year amortization. We can customize it to lower if that's at the request of the client. Interest only is an option on it. But again, we're underwriting to the debt service. It does have a 75 maximum % LTV, but if the debt service isn't there, we might have to lower that LTV. So it's something to consider. And again, these are for stabilized rentals. The other product we call our single asset bridge loan. You might know it as a fix and flip. This is typically a 12-month interest-only loan to buy a distressed property and rehab it. We've also seen folks get this loan, fix it. Instead of flipping it, they go back to our single asset rental loan and they hold it. So fix and hold is being a very popular marketplace item today. So keep that in mind when you're talking to your investor clients. On this, we finance up to 75% of the purchase, and in some cases, depending on the rehab component, we can finance up to 100% of the rehab component. Again, interest only. We'll go into a little detail of these a little bit more. I know I covered a lot of this, so I don't want to repeat myself as much as I like to hear myself speak. So again, this is a 30-year fixed. This is more for the buy and rent a client that you would have, or refinance and investing to a current investment. Again, maybe they purchased it with a hard money loan at 10 or 12%. They want to stabilize it now that they have a tenant in there. This looks a lot like your normal residential loans, the typical loan that you're seeing every day. We close these in LLCs. That's very important. The professional investment group, that's how they prefer to do it. Again, no income tax, no 4506, no W-2s, no pay stubs, no limit on the properties owned. And again, this is underwritten as a business purpose loan. So what that means, there's no TRID. Right. So yes, no TRID, no LEs, no CDs. We'll use an old GFE and a HUD-1 to close the loan. That gives you the opportunity not only to earn points on the loan, you can also earn a yield spread premium. For those of you that are as old as me and have been in the business a long time, you remember there was a thing called yield spread premium. But since these are commercial loans written on residential investment properties, there is no TRID, so we follow kind of the old rules. Also, licensing requirement, NMLS not required. It gives you the opportunity to originate loans in the states that we originate loans in. So the footprint, 40 plus states throughout the country, it gives you an opportunity to expand your marketing footprint. Real quick, we'll talk briefly about the term loan, the portfolio loan we mentioned. This is commonly known as a blanket loan, I know, in the residential mortgage industry. Single families, 2 to 4s, condos, townhomes. We'll put some small multifamilies in these portfolios. The main thing to understand and remember is we need 5 units and 500,000 minimum on these loans. Again, it's underwritten with a debt service coverage, maximum 75% LTV, to a 1.25 DSCR, again, debt service coverage ratio, fixed for 5 or 10 years. And the other third product we'll go into a little bit of detail more about is the bridge loan. So on this single asset bridge loan, as I mentioned, this is typically for a distressed property. What you're looking for is a property where you're going to either buy it, fix it up, or you're going to go in and buy it, and you might flip it instead of renting it out. So again, huge market here, over 50 billion annually, growing and growing every day. Keep that in mind when you're looking at these distressed assets, that we might be able to help you originate those loans. I think we've covered the products there, Eric and Chris. Maybe if you have some more polls, we can go ahead and do that. And some surveys for the audience. Oh, thank you so much.
I'll tell you what, Sam, if it's all right with you guys, why don't we go ahead and jump into answering a couple of questions? There were several that came through the Q&A. And guys, by the way, audience members, this is your opportunity to pick the brains of these experts and really find out the nuts and bolts of what you need to know about how to do these loans. So use this opportunity to ask those detailed, specific, even if you've got a specific scenario that you want to know more about. Go ahead and let us know, what you want to hear more information. Use this opportunity to pick the brains of these experts by typing questions into the Q&A. One of the first questions is that came from Mo is LLC or INC or Inc. vesting. Is this a recourse loan or a non-recourse loan? And help us understand a little bit more about how that plays out, Sam.
Well, again, it's different for every product. I'll speak to the single asset is going to be a recourse loan. And Chris, do you want to comment on the term loan and how it works on different loan levels?
If Chris has himself a microphone. Tell you what, guys, why don't we go to some poll questions really quickly? Sure. If you guys are thinking through and answering some stuff in the Q&A, we'll go through this. Guys, from the audience perspective, we want to know a little bit more about where your opportunity and interest is as we direct the rest of this conversation we're having with you here. So the first one is here, have you ever turned down or referred away, you said same ones as earlier, have you ever turned down or referred away any loans or portfolio rental properties? We'll revisit this. You know what? Okay. So guys, tell you what, we're going to move on to the Q&A section as we move ahead today while we're trying to work out some of the technical difficulties on the back end. Gabby or Christy, if you could let me know when Chris is back online and ready to go here.
I'm back. I'm sorry, it was on mute.
All right, awesome. So the question, Sam, why don't you go ahead and re-ask the question that you wanted Chris to answer before? And
Chris. So the question from the group came in on recourse versus non-recourse. I was speaking specifically to the single asset rental, that is a recourse loan. I know on the portfolio term / blanket product, there's different levels of recourse and non-recourse depending on certain factors. I was wondering if you can comment on that.
Yeah, that's exactly right. So we can do those loans either recourse or non-recourse. Those assets, those portfolio loans are done exclusively to LLCs or corporate single-purpose entities, and they can be completely non-recourse. For smaller loans, we'll go recourse, and really the big difference is we have a slightly reduced reporting requirement for the recourse loans. We are requiring rent rolls to be reported on a regular basis. So a smaller loan can be recourse, but most often, about 75% of that product is done on a completely non-recourse basis.
Okay. We have another poll question up there. Again, we talked about it before. Do you ever have clients request to close loans in LLCs? And I would even throw LPs in there too, because we do allow them.
Yeah, we do. The term loans are all in LLCs. The single asset loans we can do to an individual or to a partnership or LLC entity.
Hey, here's another poll question. Are you aware that you can offer some investment property loan programs in states that you're not NMLS licensed? I find out when I travel throughout the country that folks aren't familiar the fact that these are, again, commercial loans on residential rentals. Just want to kind of get a survey of our audience here, if you were aware of that. All right, thank you. Well, again, we've talked about the marketplace. We've talked about CoreVest. We've talked about the different programs. So the question is, again, how do you partner with us? We've partnered with hundreds of broker partners, real estate professionals, finance professionals throughout the United States. So kind of how in the Jerry Maguire spirit quote from the movie, show me the money. So how can you earn money working with CoreVest? We'll take a look at some of the distribution channels that we have. A quick referral is one of the ways. Again, on the quick referral side, you're going to provide us with a short form of the client that you have. Maybe you're not familiar with the programs. You don't want to deviate from the current programs that you're doing. We will follow up with it. We work with our originators. We'll get those loans closed, and you will be paid a referral fee on that. Our Broker Plus program. This is one of our newer programs, just rolled out in the last few months. We're signing up, I don't know, at least 10 brokers a week on it. Very, very exciting. This allows you to work on the loan, but we're going to do most of the processing on it. So we just ask you to gather some of the initial agreements, some of the initial documentation, and then we will process the loan for you. We'll order the credit. We're going to order the appraisal. We're going to do the underwrite. We're going to order the title. And again, you can earn on this one yield spread premium, as well as you can charge points on this. So it's very, very appealing. Again, and that way it doesn't take away from your core business. The wholesale channel, again, this is pretty much like what you're normally doing today if you're a wholesale mortgage broker, where you're going to control the ordering of the credit, you're going to order the appraisal, you're going to do the processing of the loan, and we're going to do the underwrite. We'll coordinate the closing with you. We'll draw the docs. It closes in our name as the lender, and you have the opportunity to earn yield spread. And again, charge points on those loans. More than happy to get you the details after the conference call here today. And then correspondent. Traditionally, we have two sides of correspondent. Our non-delegated correspondent. That's where the client is doing all of the work. You're going to do the credit, of course, the appraisal, the processing. You'll send it to us for the underwriting decision. So we'll take on the risk for that. And then we'll go ahead and coordinate the closing. You can draw the docs, we can draw the docs, we can work on that together. You're gonna fund with your own funds, and then we buy that loan immediately back from you. So it does close in your name. And of course, the true delegated correspondent, that's where you're gonna take on the underwriting risk, and you're gonna go through the whole file flow, the whole life cycle of the loan, and then you sell us a closed loan at the end of the day, or end of the week, or end of the month, whatever it might be. So again, lots of different ways you can deliver product to us. I know your time is valuable. Let's talk about some next steps and quick action items. I'd like you to take back a look about 60 days and see if there's any investment properties that perhaps you had to turn down. It could have been, maybe they weren't an LLC. Maybe the DTI didn't work full doc for Fannie or Freddie. Perhaps they own too many properties. So take a look at that. Look at the immediate contacts and clients you've worked with over the past year, over the past 3 years, even the past 5 years. Maybe they own portfolios of rental properties. Now you have a product that you can come back to them and say, hey, Mr. and Mrs. Investment client, you own 12 rental properties. Did you know that you can leverage those into one loan, or even a portion of them into one loan? You can refinance them to a lower rate. You could cash out and perhaps buy some more rental properties. Again, now you have an opportunity to do that with programs like ours. And again, most importantly, contact us to review scenarios and answer any questions that you might have on this growing space, this growing opportunity in the residential investment rental market. So again, current and past clients, leverage our rehab expertise and our experience in the investment markets. Also, I'd encourage you, for those of you that do direct marketing, maybe you drop mail, maybe you do, you have a dialer, whatever it might be. Get your marketing folks on the phone with me. Let's talk about it. We can maybe put you in the right position with some vendors. I can talk to them and say, hey, look, this is the box we need to put the loans in. Just leverage my industry expertise and let me help you grow and earn your business.
Sammy, based on the poll responses, over 80% of the people on the call have clients who are active in the investment residential market.
Wow,
and the majority of them have had customers who didn't meet Fannie, Freddie, DTI guidelines, or have foreign national clients. So I think this could be a really attractive product for many of the people on the call.
Great. That sounds that's great. One thing I'll encourage you to do is take advantage of the resources available. There's a live download page on this platform. We have our broker approval forms. We have some other information about our matrix and guidelines. And of course, we can always get together after the call on that. Also, we'll be emailing out the winner of the referral contest. We do appreciate you participating in that, as always. Another thing, our website, corevestfinance.com, our partners page. Take a look at that when you get a chance. We typically have our upcoming webinars on there. We have our trade show schedule on there. Not only is it great doing webcasts like this and meeting with you, the other most important thing is meeting someone face to face. You like to be able to know someone a little better, and that's a great opportunity to do it as we do our road shows throughout the year. So I think with that, we'll take some Q&A. Eric,
okay.
Chris, if you have some.
Awesome, guys. Well, there's plenty of interaction coming through, and we guys have a lot of different questions that are coming through here. We'll just kind of pick and choose a little bit as we go. The first one comes through, from Dylan. I won't try and mess up that last name. It says, for the portfolio rental loans that you guys do, how much of your production is 5-year versus 10-year? And how much is IO versus full AM? What do you feel the investors really benefit from most and are most attracted by when it comes to that product mix?
Yeah, the majority of our term loans have been 5-year. I'd say it's about 75% 5-year, 25% 10-year. They do have yield maintenance, so people who want some flexibility in trading or selling assets might go with a 5-year product. People who are kind of set in stone and just want to lock in a good return on their portfolios might go for 10 years. The ability to go IO instead of amortization really depends on what the leverage is. So if you're below 65% loan to value on a 5-year product, we'll go IO. If you're below 60% on a 10-year product, we'll go IO. Otherwise, we're on a 30-year amortization.
Okay. All right. Another question from Rochelle is, will you allow a lower debt service coverage ratio or DSCR with higher credit scores at any loan size? The old risk versus reward, FICO versus profitability.
We do make exceptions. So we'll take a look at the full credit package. 120 minimum debt service coverage is our guidelines. Certainly in certain coastal markets or places where asset yields are low, we might go with a lower debt service coverage ratio, particularly if it's a low loan to value ratio. So if it's a lower leverage loan, we can offer some flexibility on what the debt service coverage ratio is.
Okay. All right. So it's not necessarily hard-coded guideline, DULP style underwriting. There's opportunity for common sense underwriting to work with you to try and make deals work, right?
Absolutely. I think that's one of the benefits of working with a private lender versus an institutional regulated lender, is that we can take a common sense approach to transactions.
Yeah, definitely a partner in the success of the project as well. All right, so another question here that said, what about mixed use properties? What about those half residential, half commercial properties?
We'll look at mixed use properties. I think we want to keep the non-residential component to below 20% of the overall income, ideally below 15%, but absolutely something we'll take a look at in the term product or in the bridge product. But not obviously.
So would you actually do that for a business owner who, I'm thinking like somebody who owns a restaurant or a dry cleaning shop, and they want to buy a property that is also, 25% residential on top of 75% commercial?
I think it would be the inverse of that. So 25% commercial and 75% residential. So someone had their dry cleaner in a retail shop and had apartments above it, is something we could take a look at. Although dry cleaners in particular are a little bit more challenging, but chemicals and all that. Something we could take a look at.
Okay. The reason I ask is just, thinking about opportunities, because, I know you guys said you really don't do owner occupied, but if you had a business owner buying a mixed use property who wanted to live in one of, especially if there were multiple rental units, is that a project you'd look at, or?
No, we would not be able to do anything where the owner or its family was occupying the property. These are specifically meant to be non-consumer loans, business purpose loans. So if the borrower or a member of his family is living in the units, that would disqualify for our programs, because we're trying to stay out of the consumer lending business.
Understood. Okay, great. All right. So Sam, one of the attendees on the program said, please send us your broker package to TS Mortgage. Gives you an email address. We'll get that in there. By the way, for everybody on the audience. I'm sorry, what?
Great name, by the way, on that question.
Of course. Only a Samuel would love a Samuel, right? No, I'm kidding. We'll have to fix that one over a beer one time, right, Sam?
Yes.
All right, so here's the, folks, for the audience and attendance members, continue to pound through these questions, post them in the platform. We'd love to interact and have more opportunity to identify more what you guys want to know about. Do want to remind you guys again about the opportunity to refer a colleague, that little paper airplane widget at the bottom of your screen. If you hit that button, the more times you do, the more people you invite to this program. Obviously, they're going to get almost the identical experience to what you guys have gotten on the rebroadcast. The links are all the same, so please make sure you share this with your friends and colleagues that you think are going to benefit from this, because I think there's a lot of great information here. Obviously, these guys have thrown a ton of information at you in a very short bit of time. Those broker packets, by the way, are in the Resources tab, which is the icon that looks kind of like a clipboard, or like a document with a folded tab. It almost looks like a Word document icon, the widgets. If you mouse over the widgets, by the way, guys, you'll see specifically which widget has the resources in it. The broker packets are in there, guys, or you can go to the CoreVest website to get more information about that. All right, other questions here, again from Samuel. Please, can you do multi-purpose residential home use for commercial, like children's daycare, in-home daycares, or other home-based businesses? Is that enough commercial for you guys, or because it has a residential component, is that going to throw it out?
We're stretching the boundaries of what's residential, so we're doing things like student housing and senior housing. We haven't been financing assets that are not used for a residence. So something that's a daycare center and is otherwise non-occupied, we look at that more as a commercial component. And the rules that I talked about before would apply, that we try to limit that to 20 to 30% of the overall package.
Okay, great. All right, let's see. Where can we get a summary of your programs and guidelines? Sam, if you wouldn't mind just kind of reiterating, where do they go to get that information and access those resources?
Yeah, of course, CoreVest Finance, we have information on all of our programs, as well as we should have some on the resources widget page that you mentioned earlier today. Also, feel free, you can email me at samuel.b@cvest.com. That's the letter C, VEST.com, and we'll be more than happy to have a relationship manager or account executive reach out to you with those programs.
All right, cool. Let's see, one of the questions that came up a while back, I'm going to search for it here for just a minute. I think I typed an answer to it, but I was going to get your guys' opinions. You know, where can you go to find more of these loans? If an originator is not already doing business in the investor space, where do they go find more investors?
Well, I would say, first of all, depending on what type of marketing or what the way you're doing your business now, I wouldn't reinvent the wheel. So if you're doing direct mail, or if you're doing a dialer system, or if you already have, you're doing networking activities, or you're doing presentations for first-time home buyers, for instance, let's take that and let's tweak it towards the investment market. So instead of doing first-time home buyer seminars, let's do seminars for investment property owners. And you can qualify them by reaching out in your marketplace to the realtor connections that you have. They'll be able to, they know who are buying the investment properties. That's one way. Again, if you're doing some of the more intense marketing, feel free to contact me. I'll share my industry experience with you. I'll work with your marketing team, with your direct mail team. We'll kind of tweak the way that you're sending the information out to help you aggregate more interest in these types of loans. So there's a couple different ways. There's, again, between social, there's a lot of ways out there. I could do maybe we'll do a whole webinar on that too, Eric.
Yeah, we really could. Just my 2 cents as a business development coach and trainer for the better part of the last 15 years, where my coaching clients have seen the greatest results from it is really going after the people who know the people who are wanting to buy investment properties, be that financial planners, CPAs, even local property management companies, because all their clients are real estate investors. If you happen to be lucky enough to be in a market where there are a couple of professional trade groups, like one of the bigger ones nationally is called REIA, Real Estate Investors Association of America. If they happen to have a local chapter, you can do searches for that. And that's a great way to get into the space if you're not already in it, don't already have the customer base footprint. The more you do of these, the easier they get and the more experience you get with it. The other great thing about working with investor loans is most investors want to buy multiple properties a year, year after year after year, because they're trying to build a future income stream for themselves, right? I mean, what better way to create residual, repeat loan flow for yourself, right? All right. Okay, there's a question here from... I'm assuming that's Georgeois or Georgius or Gorgeous. Sorry if I'm mispronouncing the name. For the non-recourse portfolio loans, what's the approximate minimum evaluation of the portfolio you are looking for?
Well, as we said before, we're targeting a minimum $500,000 loan amount, and we want a minimum 75% or maximum 75% loan to value, so that would imply about $625,000 of value.
Okay, so that's a decent sized portfolio.
Right.
What are the products you guys
point out that we're looking for assets? Each asset in the portfolio should have a trading value of $50,000 or more.
Okay, all right. Trading value of $50,000 or more. Okay. All right, so here's another one from Robert Dell. Thankfully, it's an easy name this time. How about financing rooming houses?
Yeah, that would be a little tough. We are focused on permanent residences. One of the underwriting requirements we have is that the leases initially be for 12 months, and then they can roll to a month-to-month lease thereafter. I think a lot of rooming houses are really start out as a month-to-month unit, and they're really not full. They're more like SROs or one room that's not a full unit with a kitchen and a bathroom. So I think that would be a little tough.
Okay. So temporary housing, condotels, those kind of things are not necessarily your guys' cup of tea, right?
Exactly. We're trying to provide financing for permanent housing.
Okay. Here's an interesting one. Anthony Jennings asked the question, I am an MLO signed with a lender on its retail side. Can I also sign up with CoreVest? LOs who work in more of a captive environment and aren't allowed to broker, can they work with you guys as well?
Well, I would, first of all, I would want you to check with your employer. We don't want you to violate any employment agreement that you have with them. What I have seen in the past is with the if the current company you work for has no desire to broker out loans or to do business with us, they allow certain originators to set up their own LLC. So you have an outside company that you're originating these loans with, and then you could submit and get approved with us that way. I would love to get the whole company signed up. Of course, we'd love to get our product out to as many folks as we can. But I would say I don't want to tell you something that goes against your employment agreement with your current company. But that would be the kind of way to do it.
Yeah, that might be a little challenging. Get yourself fired because you want to get into this space. But, as originators, we're self-employed. We kill, right? So the element of it is do we, do what's best for us and our family, or do we, continue to leave ourselves in a more restricted environment? You always have to weigh the cost and benefit of those types of situations individually.
One thing I'll add to that, Eric, is I would bring it to your employer, because a lot of these companies aren't aware of the products that we're talking about today. And again, volume is somewhat slowing down across the board. I know that the streamlined business is kind of tougher to do these days on the government side. So the owners of the company or the board should be looking for different ways to do business. This is an opportunity to do business nationwide, even if you're not a nationwide lender. So it's all about being proactive and not reactive, and really showing that entrepreneurial spirit.
And finding ways to, to help people. So, and introducing it at the company level has a lot more leverage for you as an individual. I mean, you create an additional product line that lets your company pick up 5-10% more of the business that they've previously been turning away from. They're probably going to be pretty happy with you as a colleague and an employee of the team, bringing that to them. So a lot of great information. One other quick question popped in here, Sam, with a prepayment penalty on any of your products.
Yes. So again, these are commercial loans on residential property. So on the single asset rental loan, single property loan we spoke about, that does have a 3-year prepay. It's a 3-2-1 declining prepay, and that's on the unpaid balance of the loan, not the original balance. And you can prepay. I'd have to look at the rider, but I think it's up to 20% per year without triggering any penalty. And then on our portfolio loans, let me back up. On the bridge loans, 12 months financing, no real prepayment penalty. On the portfolio loans, and Chris, feel free to jump in, we do have a yield maintenance. For instance, on a 5-year loan, it's 60 months. The yield maintenance is going to be 54 months. And on the 10-year, which is 120 months, basically it's 114 months of yield maintenance that you're guaranteeing as the investor. And that's basically how it works. Chris, do you want to add anything to that?
No, that's correct. It's yield maintenance. We have made exceptions to that. So if that's a critical ask of your client, we'd be happy to talk about it. But the majority of our loans do have that yield maintenance feature.
Okay. All right, guys. So I'm just going to take a quick aside, guys. You guys have shared some wonderful information with the audience, guys. We are getting close to the end of the time slot here. So as we wrap up, 2 things I want to share with the audience. One, audience, continue to share comments and questions in the platform. Any of the questions that we did not address live during the event, the CoreVest team, not only Chris and Sam, but a lot of the folks that support them behind the scenes are going to be available to answer a lot of these questions and follow up and make sure you get those answers. So please continue to type in those questions as we wrap up with today's event. Secondly, if whoever you think of, and I'll encourage you to try to even think of some folks that you care about, some colleagues, some other MLOs in your office, some friends that you've met at conferences across the years. Use that share invite a friend link, that paper airplane looking widget at the bottom of your screen to invite others. That contest is going to continue to run throughout the next half day or so, when we even pick up some of the on-demand folks who weren't able to join us live today. The folks that have contributed the most to sharing this information with their colleagues and friends that they care about are going to have the opportunity to win that $25 Amazon gift card. Otherwise, when it comes to the Originator Connect network, you can check us out at originators.network.com, or find more information at mortgageconferences.com to check out about upcoming future events of the webcast series. Also, watch the circulars that you'll receive via email from us, alerting you to other new learning opportunities as they come up throughout the year. Check out the live conferences as well. Here at Originator Connect, our only goal is helping you get from where you are to where you want to go as fast as possible, and giving you the tools and resources to grow your business and make more money year over year as an originator. With that, Sam, Chris, any final comments you'd like to share with the audience just before we close down here in about 2 minutes?
Chris?
Yeah, look, we really look forward to building relationships with as many of you as possible. This is a pretty large and exciting business, and it's growing every day. So please look at your client rosters and think about people who are in the investment space. I think we all know somebody who owns an investment property and is probably looking for financing. So this could be a really great way to augment your business and make some new clients.
Awesome.
And just to follow up on that, as broker owners, if you're listening, again, it's one way for you to create more business for your company. It's also a way to offer your originators more products to go out there and originate. And also it's an opportunity for you when you're recruiting new loan officers, recruiting new originators. You can say that, hey, we offer these loan products does your company offer them? So something to keep in mind. And again, just want to thank everybody. Really appreciate all your time. I know your time is valuable. Also thank all my friends and customers and clients that are texting me all these funny pictures as I'm going through this. Next time I'll put the phone in the bag, and they tell me to smile more. So there you go.
Definitely, guys. Well, thanks again for joining us on one of our Originator Connect live webcast events. Watch for future upcoming updates, like, tweet, or share with all your friends and colleagues, and encourage them to join us as a part of the Originator Connect network. Make it a great week, everybody.
Thank you.